Notice that the title of this video is not Billionaire Thinks Wells is Going to 65, because that would be a lie. But if for whatever reason you're okay with this lowly millionaire sharing his thoughts on the matter, then you've come to the right place. I believe this video will go more in depth than some of the other YouTube videos on the same topic, and I have a price target and support for that at the end, so please stick around. As of recording this video on April 20th, 2021, Wells had last closed at $42.50, so I'm looking for at least a 50% upside here. And you might be asking, okay, so you're pitching yourself as this arc-beating hyper-growth investor. Why the hell are you recommending a bank? And one that nonetheless makes headlines like this. If we look at the macro environment, you've got the interest rate curve steepening, you've got the vaccine rollout, you've got an incredible rebound or forecasted rebound in the economic recovery. You've got this unique confluence of factors that could propel cyclical stocks to gains of upwards of 50% in a relatively short amount of time. Now, there's another big benefit, and that is they're almost perfect hedge to your growth portfolio. You know, there's a lot of investors on YouTube who dub themselves as growth-only investors or value-only investors, and there doesn't have to be this distinction. I think that holding a barbell-like distribution with the balance of cyclicals and predominantly growth provides superior risk-adjusted returns against this macroeconomic backdrop. Now, guys, a little bit about my credentials. I'm a former investment banker and buy-side analyst who spent a lot of time covering FIG and tech. FIG stands for financial institutions, so not the sexiest business in the world, but you could argue that I know a thing or two about the banks. And, well, no pun intended, I quite like Wells. For full disclosure, I have over a six-figure position in the company. I've made over $1 million in the equity markets through boring long-term buy and hold positions. And I'm going to get into 3 catalysts as far as why I think the stock is going higher. Now, before I get into that, this is intended for your entertainment purposes and educational purposes. This is not financial advice. All right, you've been warned. Let's get into it. All right, guys, let's get right into the first one. So if you look at their expense guidance for this year, you'll immediately notice that it's already down or predicted to be down from 2020 levels. So cost reduction is ongoing and it seems to be working. Now, these expenses include one-time expenses such as customer remediation accruals, restructuring charges that are going away, but it also includes this $3.7 billion bucket of efficiencies across areas such as duplicate headcount, how you don't need 3 bodies to do the work of 2 people, excess branch and office footprint, things of that nature, but also investments. See, what I like about Charlie and his team at Wells Fargo is that he's not just trying to cut the business down to the bone. He could go a lot farther than that if he wanted to, but the $3.7 billion here is mostly fat. They recognize that Wells is behind its peers in a lot of areas, and what they're trying to do is actually build back stronger in areas such as technology, the digital experience, the credit cards business. So as an investor, I'm actually quite thrilled to see this. Now, the second one is something that isn't really talked about much, and that is that Wells currently has very high legal and professional expenses. It was 6.6 in 2018, 6.7 in 2019, 6.7 again last year. And a lot of this is related to the litigation in the wake of the fake account scandal and trying to get that asset cap lifted. Well, now that Wells has received preliminary approval, it shouldn't need to spend as much here. Now, I didn't see this spend as part of the $8 billion in slated or stated expense reductions. If you look at how much Wells was spending in this category in the years prior to the scandal, it was less than half of that, or over $4 billion less. It's kind of too big to fall under any of these segments here. You know, it's not really streamlining operational structure, definitely not reducing branch count. And the 10% other category is just $800 million, which is far less than what I expect. So I would view this benefit as being additive when it happens. So as the spend normalizes, we should be able to safely add back $4 billion to pre-tax income. And to illustrate this, because I think it's an important point, I've attempted to put together a pro forma of what Wells Fargo's P&L could look like over the next 1 to 2 years. For those who are new to finance, pro forma is just a fancy term that guys in my field like to use to describe a future state in which all the adjustments are baked in. Now, I know I'm starting off at $80 billion in revenue, which is higher than where they are now. But with the pandemic, guys, Wells earned over 72 in revenue when customers, small businesses, they were hurting. So as the economy and the recovery picks up steam, the American consumer is feeling more confident, Wells earns more net interest income. I really think that $80 billion 1 to 2 years down the road is really quite doable. All right, going back to our model. So if we add back the $4 billion in normalized legal and professional expenses, plus the additional $5 billion in expense synergies yet to come, that gets us down to about $44 billion in adjusted expenses, or a $9 billion reduction from management's forecast for 2021. Now, if we look at the timing of the expense synergies, management calls for achievement within 2 to 3 years. And with 3.7 slated in the first year, I actually think we could see a significant chunk of the remainder by the end of year 2 or 2022. By the way, if you think I'm taking a lot of costs out, which I am, it's totally supported by all of management's disclosure, and it just goes to show how poorly managed Wells is and how much bloat there is. If you look at their efficiency ratio, which is a metric of their non-interest expense divided by net revenue, 44 billion divided by 80 billion is about 55%, or is actually where they used to be back in 2014. So I view this as something that is relatively doable. If we go back in time and look at how Wells has traded in the past, the PE ratio has been remarkably consistent. The floor is around 10x, so to speak, and the top end is around 12 times if I'm being conservative. Now, banks trade primarily on book value, but it's not to say that price to earnings isn't important. I don't have a ton of visibility into what Wells's book value could be, but it will definitely go higher with the asset cap coming off, and I do have a ton of visibility into their earnings, hence why I'm using price to earnings. So if we put this into our model, I'm getting a price target of somewhere between $70 to $83 based on the 10x to 12x multiple. That's a lot higher than the $65 price target that I put in the title of this video, but honestly, a lot could happen between now and then, right? Corporate taxes could go up, the dividend might not go up as much as people like, so I'd like to be conservative and for there to be a little bit of a buffer. All right, these next few catalysts I'll cover rather quickly because I think they're a little bit more familiar with you guys. Lifting of the asset cap. If you're watching this video, my guess is that it's probably pretty familiar to you that the asset cap has had the single largest negative impact on Wells' share price. But if you'd like a refresher, please do let me know in the comment section below and I will definitely respond to you. So the interesting thing is that Bloomberg did a plot of the Big Four and Wells is all the way at the bottom. Like from 2015 to 2021, the share price has not budged, in large part due to the asset cap. Now, with the asset cap on its way to being reinstated, it also means that Wells has the highest potential upside, especially as ever since the cap was announced, it has actually not performed all that much better than its peers before the last round of Q1 2021 earnings. It was basically trading exactly in line with where Citi and Bank of America are. So that tells me that the market for this stock is not in sell the news mode yet, that still has some room to rally on incremental news of getting closer to that asset cap getting lifted. Now, the second is that the dividend is definitely going to come back higher. We heard from the conference call that the prior yield was probably a little bit too high, but the current yield of 10 cents per quarter is way too low. Something in line with what the other banks are paying probably makes the most sense. And if that were to happen, my guess is that dividend investors would pile back into the company in droves. Now, keep in mind that Wells can pay a higher dividend if they want to. The 51 cents that they used to pay and was deemed quote-unquote unsustainably high is well below the $1.05 that they earned in Q1 of this year. So yeah, there's tons of room there. Now, for interest rates, the spread between the 2-year and the 10-year is actually 3 times higher than where they were a year ago and could go even higher. Equity strategists have been calling it for a while that we could see rates as high as 2.25%, 2.5% this year. So yes, I'm very confident that net interest income and net interest margins should go up by quite a bit over the course of this year and the next. And again, this just goes to support that 80 billion revenue figure that I mentioned earlier is very reasonable and attainable. And the last thing I'll mention, guys, is that Charlie is, by my accounts, doing a pretty fantastic job as a CEO. I know that CEOs, we usually want to give them a grace period or a feeling out period of about a year in order to do their jobs. But so far, I think he's done a great job of appeasing the regulators, being on track to have that asset cap lifted, operationally streamlining Wells and cutting back on unnecessary expenses. This is a CEO who, if you remember, was able to more than double Visa's share price during his 4-year tenure and is supposedly Jamie Dimon's pick of successor if he were ever to retire. So yeah, there's a little bit of in Charlie we trust in this, but I do think that he seems to be more than up for the task. So if we put all these together, I think that Wells has the best set of catalysts out of the major banks. And yeah, while I'm primarily a growth guy, I don't mind holding a bank or two to get exposure to cyclicals and the recovery. And financials are almost a perfect hedge to tech if we look at the price action over the past year, this whole tug of war between the reopening trade versus the stay-at-home trade. And for those reasons, I'm very happy to have it in my portfolio. I've held about 8,000 shares at an average cost of $25, and I'm not selling anytime soon. So there you have it, guys. Thanks for watching. If you haven't subscribed yet, please consider doing so, as I'll be putting more in-depth analysis and content such as this. And if you have any questions, please leave them in the comment section below, and I will get back to them as soon as possible. Until next time, peace out.